China's stock markets have outperformed many developed countries, including the US, this year, but is now the time for foreign investors to buy in. This is Sectors Up Close, and we're talking China. China's main onshore indexes, the Shanghai Composite and the CSI 300, are up 9 and 12% respectively since the middle of July. That's more than the S&P, and it's happened despite mounting tension with the US, where a trade agreement remains elusive. So what's driving the success, and can it last? Michael Browne is a senior investment strategist at Franklin Templeton Institute. Michael, broadly, this seems counterintuitive, doesn't it, given the high US tariffs on China and a domestic economy that is still weak. How do you explain it?
Well, I think, first of all, we have to say it's better to travel than arrive. And there was a lot of bad news discounted in the prices as we got through two sanctions in the middle of this year. And once we had that certainty over sanctions, you could then start to say, well, you know what, sanctions only really cover about 3% of GDP in China. And although they are very high where they exist, that isn't going to make or break the Chinese economy. The domestic side of the economy is going to be the critical element, and that's the sector you've seen rallying.
You think, though, that China's domestic stocks are still undervalued? Why?
First of all, we have to start with the issue of deflation, because that was the other big negative that's been running in China for some time. There is no inflation in China at this point in time. If you look at it on a PPI basis, it's probably negative and has been for a while. Rates have been falling steadily. The consumer confidence is a little bit low. It's struggling to recover since COVID because property prices remain depressed. But the point is, when you get to that point, again, as I say, it's better to travel than arrive. You can start to look at some of the actions that the Chinese state is taking at this point in time to start to offset that and start to boost domestic demand. And in particular, I think this anti-involution policy that they're bringing forward at this moment, where they're going to remove excess capacity, where they're going to ask for mergers, they're going to ask for corporates to start to trim back and start to get back in line with their capacity, be it the steel sector or the solar sector. That, I think, is really important in terms of setting us up both for profitable growth and for an end to deflation.
As you say, this is a key problem in Chinese corporates, that return on equity has been falling, especially in key sectors like cars, solar panels, steel, because of this excess competition for not enough domestic demand. Do you think the government policy will go far enough at making a difference?
Yes, it'll take time, though. I don't think we should expect wonders overnight. I don't think we should expect this to be a silver bullet. It will be a slow but steady process. And that's why the valuations that we are at this moment in time, where the market sells at about a 10% discount to emerging markets and a very significant, almost a 100% discount to, say, the other biggest market in the EM sphere, which is India, I think that's why you can start to say, actually, with a growth profile next year of 4% or so, with very little inflation, earnings expected to grow in the 10 to 12% range, this is starting to look really attractive. And then you dig into the sectors and you go, yes, interesting.
We have already seen a rally, but really quite concentrated in tech companies. Do you think that's too narrow?
I think it will. I think the leadership will be in tech, because I think at the beginning of this year, in the first quarter, we all woke up to the fact that the developments in AI in China were such that they were coming up with a really good product at a really good price. And I think it's that second element in their large language models that is really driving the conversation. So inevitably, the markets have sat up, taken some notice, realised that actually something exciting is going on that could be really competitive, not just in the Chinese market, but wider, and therefore started to really drive that forward. But you've got a very powerful consumer here. You've got a big consumer, heavy degrees of savings. We think that wealth effect of negative property prices is coming to a close. We can see domestic travel begin to pick up. So yes, I think that the portents are good that this will broaden out. Don't expect anything overnight. This will be slow but steady progress.
On the AI and chip makers, though, clearly Chinese companies are spending a lot less money than the US leaders in the sector and trying to create a global product that can compete. Are they able to do that, do you think?
Well, yes, it does look like they are. Obviously, it's not going to be right up there in terms of the large language models. It's not going to be, shall we say, at the cutting edge, but it looks as if they're able to come up with a solution that enables a well-priced product to go really broad. And we've seen a number of car manufacturers, for instance, sign up to DeepSeek and sign up to the platform there. They clearly see that as a big product and a big opportunity set in the Chinese market. And I wouldn't be surprising if either the technological ideas behind that were rolled out on a backbone network or indeed actually into the consumer on a much wider basis, so outside of China as well.
Briefly, Michael, though, for a foreign investor, how nervous should you be about the potentially worsening relationship with the US if you're buying Chinese stocks?
It's always going to be in the backdrop. It's always going to be in the background. If I was sitting here at a 20% premium to the emerging markets, and I should just remind everybody that when the Fed starts to cut interest rates, it's the best markets to be in are the emerging markets. So this is a very constructive backdrop for emerging markets as a whole. But it's not expensive. It's still cheap relative to its counterparts. It's still very cheap relative to the US. And I would say you need to have a 2 to 3 year view, but this is an interesting time to start picking up some really good value stocks. You may not want to go overweight, but this is the point to actually, I think, start to build a position.
That was Michael Browne of Franklin Templeton. Don't forget, you can watch more videos on Reuters.com.